Well, I'm going to get started while our guests are working their way toward their respective chairs. They've been assigned their chairs. I'm John Engler, President of the Business Roundtable, and I want to welcome everyone here. This actually is the room where we have our quarterly meetings, and so we get a pretty good crowd for those meetings. In fact, next week we're meeting again, about 100 CEOs will be here, but we think this is actually the largest gathering we've ever had in the room. We've only been in this space a couple of years, so I want to welcome everyone here, and I'm delighted, and you have come at a most opportune time with a most auspicious panel that we have today. We're delighted to have the chairman of the House Ways and Means Committee, Chairman Dave Camp, Jason Furman, the chairman of the President's Council on Economic Advisors, and of course, in a moment I'll introduce our very distinguished moderator today, Mr. Kudlow. But we are just thrilled to be able to co-sponsor this discussion with some other leading tax reform supporters from across the business world. And I think that's why we've got such a good crowd here, because certainly this isn't just a roundtable function today. We've got the Alliance for Competitive Taxation Act, the Information Technology Industry Council, ITI, the International Franchise Association, IFA, and Let's Invest for Tomorrow America, or as it's usually called, the LIFT Coalition. And then finally, the Semiconductor Industry Association, SIA. So if you got all those acronyms down, they represent a lot of people who are very much interested in a competitive United States and go out and take on the competition globally and win. And we've learned some pretty important lessons this year. But we're here because we still believe, that Jason and I were just talking, he said, well, there's still people that believe. Yes, we believe, and we are optimistic, despite all of the reasons that you might choose to be pessimistic. But you will learn today, as I think we go through this discussion with David and Jason, that we've got some very fundamentally sound ideas, some economically important ideas that are on the table, and there's no better person to sort of tease this out who will talk about the power of free enterprise and free markets, and that's Larry Kudlow, our moderator. Many, many roles, obviously a distinguished economist, a columnist, a commentator, and notably CNBC leader today, a contributor there. So for today's purposes, I think the one thing that we would stress about Larry, and he's been relentless on this for a long time, he's a tireless advocate of economic growth. And we like to say at the BRT, we're the leading organization interested in economic growth. We know everybody here is interested in economic growth, but that's what motivates our CEOs. We want growth. And Larry has been, I think, an articulate advocate for the prospect that tax reform is the best way to achieve robust economic growth, to restore the United States to leading a global economic recovery through economic growth caused by tax reform. So, ladies and gentlemen, without further ado, our distinguished moderator, the man who will liven things up today, who will get the inside out in asking the probing questions of our guests, Larry Kudlow.
All right, thanks very much. Thank you, John. I appreciate it very much. I have known John Engler I've been pushing John Engler for so many years, for so many positions and offices. It's a great pleasure to be here. And it's not exactly breaking news, but as an alumnus of the Reagan administration and a supply-sider, I am a pro-growth guy, and I am a tax reform guy. And I want to say, as we meet this morning, we're closing in on a very important midterm election, and I understand the important influence of foreign policy. The President will speak tonight on the Middle East crisis, and that is key, that is tantamount. But insofar as our world is concerned, turning back to economic growth, I think the key issues are going to be jobs and immigration and health care. We'll focus on tax reform. And I want to read, it's a very interesting editorial today by a Clinton alumnus. Well, it's written by Jim Freeman of the Wall Street editorial board, but Bill Galston, who has appeared on the Kudlow Report from time to time, he wrote about a survey of 3,000 Americans, which was conducted last winter and spring by a Global Strategy Group. Have you seen this, the Galston editorial? Please read it. Not that it matters, but the Global Strategy Group is regarded as a democratic polling operation. And what they really come up with is a remarkable margin, I quote Mr. Galston, a remarkable margin of 64 percentage points, 80 to 16, voters opt for a candidate who focuses more on economic growth to one who emphasizes less income inequality. That's from a Democratic pollster. My view is it's disappointing under Democratic and Republican presidents and Democratic and Republican Congresses in the past roughly 15 years, the U.S. economy has only averaged 1.8% growth per annum. And that's a terrible record. That's a terrible record. That's a European-style record. And I don't like it one bit. And on balance, again, this comes under Democrats and Republicans, we have had virtually no job creation. And most of the participation rate measures, as you know as well as I do, have been woefully low. We're nowhere near catching up to where we were, let's say, in the 90s when we had a Democratic president and a Republican Congress, or in the 80s during the Reagan recovery where we had a Republican president and sometimes a Democratic and sometimes a Republican Congress. We're just nowhere near that. And that troubles me enormously, and it should trouble everybody. Second point I want to make is I want to talk about all tax reform today. We will get into this. Mr. Camp has, I think yours is the only complete blueprint for both personal and business reform. You are to be commended by that. Actually, it's a miraculous thing that you did, and we'll get to that in just a moment. But I'll just speak personally. If you want economic growth and you want global competitiveness, fix the corporate tax code. Fix the corporate tax code, all right? That's my priority. And I am going to steer the discussion in some large measure towards that. It affects business investment, which has been lousy. It affects shareholders. It affects consumers. And most of all, as it turns out by a bunch of new research, corporate tax reform affects workers and wages. And I think that's a new one coming out of the American Enterprise Institute in the last couple of years, with a lot of peer review now that acknowledges that changes in the corporate tax rate have almost 100% impact on workers and wages. And as you know, corporations don't really pay taxes. They collect taxes. And then they parcel them out in the form of wages, investor returns, and consumer product prices. This is something that one of America's great businessmen, Fred Smith, the CEO and chairman of FedEx, taught me on the air during the Kudlow report several years ago. He literally gave me a lecture on the air. And you know what? Uncharacteristically, I shut up and I just took a paper out and jotted down what he said. And what he said was, corporations don't pay taxes, they merely collect them. And the rest of the country has to pay them. I also want to just throw in, I am terribly sorry that we are involved in this highly politicized inversion debate. And I'll tell you why. Because it doesn't matter. It's a distraction. It has nothing to do with fundamental tax reform. It is merely a symptom of a disease which is called an uncompetitive global corporate tax rate. And my last point I'll make is, again, I'm not breaking news here that I'm a Reagan supply-sider. Give me 2 shots at policy to grow the economy at 3 to 4% instead of 2%. Give me 2 shots, all right? And according to the Congressional Budget Office, 1% faster growth per year will lower the budget deficit by roughly $3 trillion over a 10-year period, $2.9 trillion. That's a CBO number, not mine. And that's mostly a static estimate, not a dynamic estimate. Anyhow, all I'll say is lower the corporate tax rate, slash it 25%, 20%, or else abolish it altogether and keep the exchange value of the US dollar high. King dollar, cut the corporate tax. I guarantee you 3 to 4% economic growth. Guarantee it. You can take it to the bank. and I'm not running for anything. Thank you. Let me introduce just briefly our two distinguished panelists today, both friends of mine. Dave Camp is chairman of the House Ways and Means Committee. He's been a Republican from Michigan. I think I speak for all serious people in Washington that we are sorry he is retiring because he's done such a great job. He actually... There you go. That's the best tribute. Whoever you are, lobbyists, staff people, I don't know, you all the insiders they all write about, but you are well received by your peers, Chairman Camp. And as I say, we all regret that you are retiring. Also, my old friend Jason Furman, who is chairman of the Council of Economic Advisors. Jason often appeared on the Kudlow Report before he was famous, and now here we have him as a famous member of the Council of Economic Advisors. All right, Jason, I begin with you in this election year, and I know you have a lot of thoughts. I want to read to you something from President Obama last week, which disappointed me. He's speaking it's a fundraiser in Purchase, New York. Bob Wolf's house, former head of UBS in the U.S. Wolf is a friend of mine. And the president's talking about domestic priorities, childhood education, affordable health care, college expenses. And then he goes on to say, these efforts are going to cost money. But the truth is, we've also got a whole bunch of corporate loopholes out there that could be closed, and a tax system that doesn't work. And if all of us are doing our fair share, then all of us can do well, not just some of us. And that's what America is about. Okay, I agree that's what America is about. My regret, Jason, is that he mentioned closing the loopholes, with which I agree. He didn't mention cutting the corporate tax rates, which is my great hope. And what I want to do is ask you, can you update us on administration policies regarding tax reform for individuals and corporations? Let me begin there.
Sure, absolutely. Thanks so much for organizing this discussion. This isn't the first time I've talked about corporate tax reform in this room, and until we get it done, it probably won't be the last either. Would love to answer your question, Larry, and I want to take us back to 2010. We had spent the first 2 years of the administration focused on preventing a second Great Depression and turning the economy around. Part of that involved a number of fiscal measures. Part of those fiscal measures included a number of corporate tax cuts. First, we did bonus depreciation, ultimately working with Rohit Kumar, who seemed to be one of the organizers of this. We took that up to 100% expensing. I think those measures were temporary and were very effective in helping businesses, especially ones that had cash constraints, turn around, invest more, and get us out of that economic situation we were in. By 2010, it became increasingly clear that while we needed to continue our efforts on the short-run economy, that medium and long-run growth needed to be a major focus. And the president met with us a number of times in the Roosevelt Room, and he kept pressing us on our corporate tax rate, and our corporate tax rate being the highest in the world. There were actually some, even on the economic team, that actually weren't enamored about shifting to that. And the president ultimately won that debate with Larry Summers, saying, I'm the president, I don't need to beat you in a debate. The issue's over. I'm in the State of the Union.
How did Larry take that?
I am in the State of the Union going to talk about lowering our corporate tax rate. And he did. In 2011, he became the first president in decades that had called for a lower corporate tax rate. We'd seen a lot of tax cuts in the previous administration. We hadn't seen any corporate tax cuts. He did that year. We then continued to work to build on that. He put out a framework in 2012. I thought that was significant because it wasn't some academic study put out by the Treasury Department. It was called the President's Framework for Business Tax Reform. It was put out jointly by the White House and Treasury. It reflected a significant investment of his time and effort. And underlying all of that was what his sense is from understanding the economy, what he's heard from many of the CEOs of the people in this room in a lot of one-on-one and small group conversations over the years, which is that it's completely untenable for the United States to have a 35% corporate tax rate. We need to lower that. It's also untenable for us to be adding to our budget deficit. We've made a lot of progress on the deficit, but we still have a medium and long-run deficit. So we shouldn't be adding to it over the next decade, and we can come back to this. Shouldn't be adding to it in future decades either. Fortunately, there are all the loopholes that, Larry, you said you wanted to close. The president in those remarks said he wanted to close. We've listed a lot of them, and then we've talked about some of the other structural steps one would need to take. Many of them Chairman Kemp included in his tax reform draft. The international system, I'm sure we'll have a chance to talk about that, is also badly broken. It's probably the only part of our tax system where we manage to impose significant economic distortions while collecting very little revenue. Usually you want to sort of do one, maybe collect revenue or not have distortions, ideally both. So there's a lot of scope there as well. And he continues in conversations with us to emphasize that this is something that he sees our country being able to do in the next couple of years. I think to do it, though, does require owning up to some of those loopholes, for example. And we'll probably come back and talk more about inversion. I think that's very symbolic, not just symbolic in terms of you lose revenue, but it's actually economically meaningful. It's another example of companies that spend their time thinking about how to minimize taxes and make decisions on that benefit basis rather than how to maximize efficiency and make better products, and it hurts the U.S.
But you don't
economy.
blame them. I mean, they do have a fiduciary responsibility to deliver the highest rate of return to their shareholders.
I think we have a responsibility to make sure that the law does what it says it does, which is if you make profits in the United States, you're paying taxes in the United States, and that's something that there's sometimes more flexibility about than maybe there should be. And we set a law that decides how you can set your corporate address. If you're a majority U.S. company, it's pretty common sense that you should have to have a U.S. Tax address, and that's something we'd like to see legislative. And I'd add to that even if we did Chairman Kemp's reform of the 25% rate, you did President Obama's reform of the 28% rate, there's still going to be a lot of warm island countries around the world that have lower rates than both of those. You're still going to need an anti-inversion provision, even in a reformed, more competitive tax system.
Jason, can I just ask, regarding the overseas, there's a lot of money that's gone overseas, non-inversion money, all right? You've got multinational corporations, principally large, but some medium-sized and even smaller ones, and they've been stashing cash overseas in order to avoid the 35% tax rate in the USA. It's not an inversion, it's just a money management issue for the firms. So far as I know, correct me if I'm wrong, the president looks at that money and says, bring it home, but he has a rather punishing approach to it. He wants to charge at a high tax rate. And if repatriation occurs, he's not going to provide an incentive, he's going to provide a penalty. I may be wrong about that, but I want you to clarify, because in the mid-2000s, as you know, at least for a couple years, the administration, the Congress let companies repatriate, I think, for 5.25%, just a nominal penalty, which was almost a fee. Most people want territorial, not worldwide taxation. Does the administration agree with that or disagree with that?
Right. I mean, what we did in 2004 was a one-time repatriation holiday. President Bush signed it, but that provision in the bill was against his Treasury's objections and his Council of Economic Advisors' objections. And I would say that there's a large body of economic research, and you see it. If you look at the Heritage website, they say it. You look at the Center on Budget and Policy Priorities, they say it. That it didn't create jobs. It cost us money, and it destabilized the tax system by leading companies to expect that
Went to shareholders.
in the future. So that type of...
Went to shareholders. Not the worst thing in the world.
In terms of, but if you want, that we could have written a $40 billion check to shareholders if we wanted to get money to shareholders. And, you would have said that wasn't the worst thing in the world. I would have said there's better uses of $40 billion than that.
But in the generic point, I'll get to Dave in a moment on his integrated plan. But in a generic point, do you prefer worldwide taxation or territorial taxation?
I think those two terms have served to confuse the debate because I think the system we have now is a hybrid system. In a lot of ways, it's a lot like a territorial system in that you don't pay a lot of taxes on your overseas earnings, but you don't pay a lot of taxes because you do a whole bunch of inefficient things with those earnings in order to avoid those taxes. So it's like a stupid territorial system, what we have right now. I think what the president would favor would be a hybrid approach. It would be one that recognizes the importance of the competitiveness of our companies, but also takes seriously the issue of base erosion, tries to have a more neutral tax system so it's not affecting your decisions and, and putting a thumb on the scale for investing overseas rather than the United States. And the way we would do that hybrid is with a minimum tax. And that minimum tax would be a tax on your foreign earnings, deal with some of the base erosion, level that playing field some, but also put you in a better position for global competitiveness than you are today.
All right, thank you. Great start. Chairman Camp, let me go to you. Your proposal, which I don't think has really gotten enough attention, to tell you the truth.
I wouldn't know that from the people coming to my office.
I know, but the press has been very lazy about your proposal. I mean, I think I'm the only guy that's really covered the thing. And you came on the night you did that, and I was hoping it would snowball and get it out there. I mean, Paul Ryan speaks kindly. There's a bunch of us, it ain't perfect, but there is no perfect in this game. So anyway, you're essentially integrating. You've got 3 tax brackets on the personal side. Let's see, 10, if I get this right, 10, 25, and then there's a surtax to 35. And you have a 25% corporate tax rate. And you do knock out a lot of loopholes, and you do knock out a lot of exemptions, which I guess makes you unpopular, except to those of us that want tax reform and believe in lowering the rate and broadening the base. So you've heard Jason. I'd like to get your comments on the president's recent views, and let me give you a chance to expand on your plan and where it's going, and will it become Republican policy?
Well, first of all, thanks to BRT and Governor Engler for holding this forum, and thank you, Larry and Jason, for being here, and thank all of you for attending as well. I agree with what you said in the beginning, that this is really a national problem. We do not have enough growth in this country. I am not satisfied with 2% growth. We should not accept that as an average kind of growth for this nation. We aren't being able to hire the kids that are coming out of college because there's not enough growth there. Median incomes have been declining. I think they're flat right now. I don't consider that acceptable either. I mean, flat incomes. We absolutely are not competitive with the rest of the world. We are out of step. In the 80s, we had the lowest corporate rate in the world. Now we have the highest. Our personal code has become so complicated that people, the tax burden, frankly, the compliance burden is significant. And all of these things have weighed down our economy. And when you look at what other nations have done, they have actually moved forward, and many of them have lowered their rates and reformed their tax codes. And the important point, I think, here is that I and the members of the Ways and Means Committee put out a plan. We put out a specific plan, a plan that can be scored, and a plan that actually creates 20% economic growth, a plan that actually creates nearly 2 million jobs, a plan that actually increases median incomes by $1,300 a year. That would actually significantly reverse the current economic trend, and one that increases charitable giving by $2 billion a year. And why do people give more? Because when they have more money, Americans are the most generous in the world and give more dollars. So what we need actually from the administration is a specific plan, not just a framework, not just a white paper, not just budget proposals, but we actually need the Treasury Department to go to work, as they did in the mid-'80s, and created 2 plans in detail that can be scored so we can actually have a significant debate. I think this is a debate Americans are demanding, and I think the poll you cited shows that. But what also you see in polling is Americans know the country isn't in the right direction. They know we're not achieving what we should achieve. And we're seeing an America that is completely foreign to me. I mean, that our kids' futures won't be brighter than ours. And that's what Americans are feeling. And what their sense is that not only are things not going in the right direction, but they don't think things are going to get better. And we absolutely need to turn that around as a nation, Republicans and Democrats. We need to work on this issue. And again, the international draft has been out there since October of 2011. It's not 2011 anymore. And in 6 years, we've not had a specific proposal. And look, the initial proposal was, let's get rid of deferral. It's in the president's budget. The president talked about it. That would actually make matters worse if we're looking at competing internationally. So how do we get in step, and how do we have U.S. companies platformed and based in the United States doing business around the world? How do we help the bulk of business that is organized as pass-through entities to have a simpler, lower rate so that they can focus on what they do best, which is their mission, their business, their service? And that's what we need to do as a nation. And again, we need a plan. We need a proposal from the administration that's specific, and we have not had that in the 4 years I've been chairman.
Jason, a couple of years ago, I interviewed Secretary of the Treasury, Tim Geithner, who I might add as a personal friend, somebody that I respect and admire.
You have a lot of friends, Larry.
I do. I speak to both sides of the aisle. And Tim and I talked a lot while he was in Treasury. In fact, we just had lunch together in New York. Anyway, we were having a CNBC conference on the air live, and I got to interview him to lead off the conference. And I asked him specifically, essentially the questions that Dave Camp just asked. Where is your specific plan? I know generically what you're talking about. You speak the right language. You're a smart guy, Geithner. But we never really saw a specific plan, and it's disappointing. And actually, Jace, we've never really seen right now a specific corporate plan. I think that's fair to say. And I think the corporate thing is really getting tremendous attention, perhaps because of this inversion debate in an election year, but also, you read global stuff in the Financial Times and The Economist, and they're all talking about America's lack of competitiveness. So I know between now and November election, we're not going to get a plan, but you're going to stay on, and will there be a specific plan? When you all sit down in 2015 around the table, will the administration come out with a specific plan?
We will do whatever we judge is the best way to advance this and make it happen. And at various points in time, we've gotten different advice on that. I think the chairman is to be commended for his plan. I've certainly studied it carefully. I certainly learned a lot from it, saw many things that we had in common, saw some things certainly that were different that is a basis for discussing, and I think you're to be commended for that. Our judgment was you put out too many specifics in the wrong way, in the wrong timing, and that can just lead people to just start shooting them down and undermine it. The debate has changed a lot. The world's changed a lot since the 1980s. I wouldn't underestimate the amount of specificity. We talked about what the rate was. We talked about a lot of the specific loopholes we'd close. We talked about a lot of the broader structural changes. We talked about the structure of what we do on the international side, what we do in terms of small business taxes, and a range of other things. So I think anyone in this room who wanted to put together, our plan wouldn't have that hard a time to do it from that framework. And I think that was a big advance. The Bush administration, their corporate tax reform was a white paper out of the Treasury that was an academic study of 3 stylized models.
Right.
I would teach that in class. I thought it was terrific. It had a ton of, more footnotes than our paper did. But it didn't commit to one of the 3, and all 3 of them were very stylized. So I think, we've tried to balance by putting forward a framework, but we'll always keep thinking about how we can best advance that debate.
Okay, so this guy to your right produces a specific plan. I mean, I don't have the plan in front of me because I'm not strong enough to carry it around. 950 pages, okay. But
I carry it with me everywhere.
Yeah.
It's on my iPad.
I have the Tax Foundation summary of your plan, which itself is really small print. But, for example, you've got, let's take small business. You'd have the S-corps and the pass-throughs pay the lower corporate tax rate. Now, I think that's a really good reform right there. And we had this in the 1986 bill with which I participated. And the individual rate dropped below the corporate rate in those days. And so all the S-corps and the little guys re-registered, right, and took the lower C-corp rate, which was 28. The corporate rate was 35. In fact, that's really probably the biggest mistake, Thomas Piketty and others. They missed that. It looks like a gigantic shift in income ownership. It's not. It's just a shift in how it was incorporated. But do you agree that the small businesses could switch if you have a lower corporate rate now and the chance of getting a personal rate below 35% ain't that great at the moment? We'll see. So let's say you drop to 28 or 25. Would you let the S-corps and the LLCs take the lower rate?
Two things. One is one of the principles of the president's approach is that we should be cutting and simplifying taxes for small business in whatever we do. So if we do business-only reform, you can't just make that broaden the base for everyone, cut the rates for the C-corps, and let the small businesses see a tax increase. And there's a number of ways to do that. Things like Section 179 expensing is a way of making sure you're targeting those businesses and their investment. The second thing I'd say as an economist, how I look at the issue, especially as it pertains to larger businesses, is don't look at the statutory rate. Look at something that maybe Larry, you even taught me. Look at the effective rate. And if you look at a C corp, you're getting taxed on two levels. You're getting taxed at the corporate level, and the dividends and capital gains are partially, somewhat, occasionally taxed. Pass-through doesn't have that. When you look on an integrated basis right now, large pass-throughs are actually paying a lower rate than C corps. And that's one of the non-neutralities in the tax system. And if you want a tax system that's not distorting choices, you want a tax system that has a similar rate for different types of organizations, you probably want to be moving in the other direction.
I don't pay a lower rate. I'm an LLC. I have to pay the personal tax rate.
Do you then pay dividend taxes when you remit your earnings to yourself? You want to take all that into account.
No,
You've taught me that.
No, I do it honestly. I mean, some people, right, will try to pull that. No, I do it honestly. I pay my payroll tax, and then I take the rest. And,
right.
and but I think it's a big point because, let me go to Chairman Camp. Tell us, what was your logic in doing this? Maybe that's the best way to look at it.
Well, a couple of things. If you don't do a comprehensive approach, you don't get the economic boost that you need, because much of American business is organized as pass-through entities and they pay tax as individuals. So if you want to grow the economy, create jobs, and really have an economic impact, corporate only doesn't really get you there. And so we do need to look at business reform, I think, as an important point. And the other item that's really holding us back that I didn't mention earlier is the temporary nature of our tax policy. We're the only nation in the world that has temporary tax policy provisions that expire, and then we retroactively put them in place for a year, which has already passed, and then they go forward a year. So literally you only get a year of certainty, and this is to plan to whether to hire people, to build a plant, to buy equipment, and it's just unacceptable, and we're way out of step in terms of that, and we do need to modernize our international tax laws. There's a lot of dollars stranded overseas that I'd like to see begin to regularly flow back to the United States and be invested here and not be trapped. And we know when dollars stay in a place, they're not going to just sit there. They're going to be put to work.
How would you do that?
Well, we do in the draft. We reform and modernize the international tax system, and we deem repatriation and then change the law permanently. So
and the rate?
We become more in step with, we have two rates. But the important thing is we have specifics out there. And what we don't have are specifics from the other side. And at this point in this whole process, after years, we actually need to have a specific proposal. And look, we did this with almost just a little over 50 people in the Joint Committee on Taxation and the Ways and Means Committee. And some of the people from the Ways and Means Committee are here, and Sage Eastman and Warren Payne and John Traub, who started on this before he went and found a better life. But there's 1,000 people in the Treasury Department. I frankly think they have a proposal that we just haven't seen. I'd like to see it. I think they haven't been sitting there twiddling their thumbs. I think they've probably got something. So let's put it out there. Let's find out what the specifics are. And then we can actually have a debate about this, a public debate. I don't think we should be afraid of the debate. And the reason we have to have a public debate, is this stuff is too important. It's very complex, and I can tell you, after 3 years of working to put the draft together and another year of almost 9 months of hearing specifics on the draft as it's gone out there, this is something that we need to have a robust public debate on. And I could negotiate with myself. I don't think it would get anywhere. But I can't really counter what I've done with a nothing. And you can't counter a specific plan with a framework or a white paper. And so at this point, we really need to have, and look, I think we all get elected to lead. We need some leadership. And yeah, do you get a lot of slings and arrows if you try to lead? Yes. But that's what I think we really have to do. If we want to move this country forward, if we want to have the strongest economy in the world, which we're certainly capable of doing, and frankly, you mentioned that we're not going to talk about foreign policy, and we shouldn't. But one of the things that really brings you strength in foreign policy is a very strong, robust economy. Mm. And I had a very important person, a former administration official, come to me and say, you know, Dave, the Chinese aren't going to listen to you until you get your economy in order. We were talking about another issue. But so it actually goes hand in hand with everything else. And if we want to make sure that we're taking care of the least of those in our country, we can't do it without strong economic growth and strong revenue, strong tax dollars, and people actually doing better than they are today. And that isn't the case now. And
right. I mean,
that's why we got to do those things.
Can I just interject a little bit? I mean, I absolutely think we can always improve. And that's what we're trying to do here. But I don't think we need to undermine the way we talk about the economy in the process. I spend a lot of time at international meetings at the OECD, elsewhere. And I can tell you, you go around that table, and the United States is the envy of the world in terms of where our economy is, the highest productivity in the world, what our growth rate is compared to much of the world. You look at the unemployment rate right now. Last year the forecasts were that it was going to take till 2017 for the unemployment rate to come down to 6.1%. It's come 3 years ahead of that. Job growth has picked up this year. Economic growth last year was at 3%. The last quarter was very good. So I don't think we want to be undermining the U.S.'s economic strength and underestimating it. That's not to debate with you at all, the proposition that we can build on it and strengthen it.
Yeah, I don't want to be like Europe. So I believe in American exceptionalism. We are used to historic growth much above where we are, and there's no reason why we can't have that now.
Right. Yeah, I mean, Kudlow goal, 4% growth, coming off the deep recession. What you say is right. I don't want to get into a debate about the economic stats. There's a lot of pluses and minuses to the employment story. You would agree with that. I don't want to go there. Here's where I want to go. What are the complaints? Let's Business Roundtable. I've moderated a couple of panels for the CEOs for Governor Engler. And these are smart guys. Some of them support Obama, some of them didn't, but they're smart guys. So you hear basically two things. One, our corporate rate is too high. We're at 35%, plus whatever, 4 or 5% locally, state and locally. Our neighbor up north, Canada, is 15% plus 11 provincial, so they're way below us. OECD, I don't know, Jay's 25% average, something like that. So a lot of people say we have the highest corporate tax rate in the developed world. I think that's mostly true. So they want it to come down. They want to come down. I hear this in the last several. I think I've done 3 in the last 3 or 4 years. That's one point. Second point is there's a lot of cash overseas. A lot of cash. Now, look, we live in a multinational global world. That's the way life works. They'd like to bring a lot of that money back home. And Lord knows we could use it. Business, equipment, plants, structures, it's the weakest part of the recovery so far. I regret that. I'm not going to point fingers. I'm just going to say there is a link somewheres between the high corporate rate by the money overseas and the low business investment. Business investment creates jobs. That's really part of the deal. So I want to get you to, on this point, why can't we repatriate at a very low rate? And I would do it permanently, Jace, I would. I don't care if the money goes to shareholders, because shareholders reinvest. But I think if it were a permanent issue, you would get more direct investment, long-term, 5 to 7 year structural type investment, which we have not had in this recovery, at least not much of it. And I'd like to lower the corporate rate, not only, Dave Camp, because we're not competitive, but I don't think we're hospitable. In other words, I want foreign money to come back to the U.S. Now, I agree the European recovery is terrible. I totally agree with that. But I want us to attract money. I want us to be a magnet for foreign capital. And if you ask me, you may not agree, I think A, you need a steady, reliable dollar, and B, you need competitive tax rates. That's what I'd like. And I think those are the biggest issues we have. And then I want to get to the personal code in a minute.
I think there's a lot of agreement on a lot of things here. I think one important thing where maybe there's some disagreement is this isn't the only economic issue we face. We need to invest in our infrastructure. I think one of the good things about your draft that the president has is both of them would use some of the transition revenue for investing in infrastructure, care about education and training. And we also, and this is something I hear from a lot of the same CEOs that you've moderated in forums, still have a medium and long run deficit problem. That deficit is smaller than it was a couple of years ago, thanks in part to some things we've done together, some things we've done separately, but it's still there. And when you solve one problem by making extenders permanent and dealing with some of the business uncertainty, and do it while compounding the other problem of your long-run deficit, you're not helping the economy, you're hurting it. If you have a business tax reform plan that is revenue neutral, or a tax reform plan that's revenue neutral in the first decade, but increases deficits by hundreds of billions of dollars in the second decade, that also is may help with one problem, but it's making another problem worse. That makes life a little bit more difficult. Your business tax reform plan is a little bit less attractive, measured purely in terms of business tax reform, if you're caring about what it does to the deficit, but it's better economically.
Yeah, but low rates,
if you're lowering the rate
rates
and you're doing it without
low rates promote growth. And again, I invite attention to this work done by AEI, but they're not the only ones doing this work. The linkage between corporate tax rates and worker wages is now firmly established in the economic literature. Now, you can argue about the percentage elasticities effects, but nonetheless, it's permanent. So I say you got a growth impact. I don't know if the CBO will score as growth. You've got a pro-growth impact on dropping the rates and improving, providing incentives to bring the money back home. But look what Camp's got here. I'm just going to read this. This poor guy, no wonder he's going home. Under the Camp proposal, I'm reading from the Tax Foundation analysis, which was a year or two ago. Under the Camp proposal, a number of credits and deductions for the oil and gas industry and green energy are repealed. And I go, whew. So look, eliminates percentage depletion, eliminates credit for producing oil and gas from marginal wells, eliminates enhanced oil recovery credits, eliminates deductions for energy-efficient commercial buildings, eliminates alcohol used as fuel, eliminates credit for biodiesel, renewable diesel used as fuel. This is all the Bush stuff that he's taken back, too. It's not just, it goes back a ways. Eliminates passive activity, except for working interest in oil, eliminates a credit for electricity produced, blah, blah, blah. Blah. The guy, look, if you take off your shirt, there's scars on his back from all of those deduction eliminations. But at the same time, that's why people in this room gave him a huge ovation for his service. And I think you got to come up with your, we got to hear, if we agree that lower rates will require a base broadening, and we agree we're going to have to eliminate deductions, and I haven't even gotten to the personal code yet, then let's put it all on the table, and let's go at it.
Well, over the last 4 years, employers and business leaders have come in both informally in meetings and formally in testimony before the Ways and Means Committee and said, we have to lower our rate.
Right.
We're not competitive. We need to simplify our code. And many have testified and said, if we can get a lower rate, we're willing to put everything on the table. Now, look, somebody else may make different trade-offs than the committee did or than this draft did. But what a specific plan allowed us to do is actually get not only a static score, but for the first time ever, a dynamic score. And I think one of the advances going forward is never again will we have a tax bill that doesn't give us a dynamic score. And this dynamic score says there will be growth. And look, growth for a decade may not be good enough. But let's see what the alternative is. I mean, certainly the alternative, I don't think anyone in America is satisfied with where we are right now. Have there been some improvements in some places? Yes, but I don't think they're good enough. And so others may think they are. But what would you do to get us to this place? And I think that it is so important that we actually do that. And one of the things the lower rate does is it deals with not just the growth issue, but it deals with some of these things that are distractions, like the inversion issue. Look, we tried to deal with that in 2004. We couldn't do it. Actually, some of the proposals out there now wouldn't address the Burger King issue. And so the way to do it, and actually Secretary Lew wrote me a letter and said the best way to do it is comprehensive tax reform. So, we know this is the way to deal with so many things. So let's move forward. And look, if there is something at Treasury, put it out after the election. I understand we're in this very tight time period right now, but do it after the election. And at least let's get sort of this discussion and debate that we need to have that compares the two approaches. Look, if this approach isn't the one the American people want, let's find out what another approach might look like. And only with a very detailed plan can you get the Joint Committee on Taxation. And not just them, we've had 3 or 4 other outside groups that have also said this plan creates growth and jobs and reduces the deficit. And if you do that, you could actually take those dollars and pay down debt, you could change some of the policies, you could lower rates even further. I mean, but that's what we need to have. Yeah, is it hard? Yes, but I don't think it's, other countries are doing it. And look, you've mentioned Canada, 15% rate. With the integrated supply chain between the United States and Canada, I don't think we can sit by and say our neighbor has a rate so vastly different from ours. And I agree that there is the effective rate and then there's the statutory rate. But the testimony we got in the committee was the statutory rate is important and we need to lower that statutory rate. And obviously not all industries actually have a lower effective rate. Some are very close to the statutory rate. So what we want to do is also have a code that, and we're going to get to the personal side, but I think clearly the simplification part of it is a big key. That's what also helps bring the growth. It's not just the rate. It's all the pieces put together. And yes, it is a complex, I call it a 3-dimensional Rubik's Cube. I mean, I guess they all are 3-dimensional, but it's on several levels that you're putting all this together. And it takes time. It took us 3 years. And that was with extensive public hearings, extensive bipartisan discussions, working groups, all of those things. And I think America's up to it. I think they're so ready for this. I just hope we can get to it.
Jason, may I ask, I want to segue. I mean, we don't have forever, and I want to get some questions from the group. Jason, let me just ask you. Chairman Camp's personal proposal. Let's get he's going to consolidate brackets from 7 brackets down to 3 brackets. The 3 brackets would be 10, 25, and effectively 35. That last bracket is for what, 400,000?
Yeah, it isn't really a bracket.
It's a surtax.
Definition of income. It's more like the bubble rate in the 80s, but anyway.
Okay, that's essentially what you got. He wants to eliminate the AMT. He wants to index the brackets to a chained CPI. And he wants to eliminate the personal exemption, eliminate the P's provision, which limits itemized deductions, eliminate state and local tax deduction, which I love. I was at that point, I love that. They'll all spend less if you do that. Eliminate the AMT, already said. Eliminate deduction of interest on education loans, eliminate adoption of tax credits, adoption tax credits, eliminate first-time home buyer credits. What's, just, you're Chairman CA, do you agree or disagree? Agree or disagree?
like a lot of things, there's good things there. The president proposed to limit the value of tax expenditures, deductions and exclusions to 28 cents on the dollar. Chairman Kemp's draft has another way of getting at that and limits them to about 25 cents on the dollar. So there's some similarities there in the basic structure of how you're tackling tax expenditures between the two approaches. There's also some differences. We don't judge tax reform, individual tax reform, by what you do to the top rate. We judge it by what it does for the middle class, what it does for people working to get into it. Chairman Kemp's draft has a lot of good things. It also, by not continuing some tax credits, would result in taxes going up on 25 million families by an average of $1,000, and that's the type of change that would trouble us.
Which families were
Yeah, that's not true, because the Joint Committee on Taxation says that actually every bracket is revenue neutral. So
That's
and the reason we do that is because we raised the standard deduction so that 97%, or basically most taxpayers don't itemize. But we were very careful in the drafting of the bill to make sure that there is not a change in any category of income. So.
Right. And that's relative, of course, to current law. So you would effectively let those expire. And when the president proposed to let low tax rates expire on high-income households, you at the time would have described that as a tax increase by not continuing those tax cuts. So I'm using basically the same language and framework you would have used. But it doesn't matter. I mean, it doesn't.
We go from
these are
15
details
to
we
10.
can talk about.
We go from 15. Yeah, well, that's what we need are the details.
Right.
But we go from 15 to 10 as the first dollar paid. So we actually lower taxes for the first dollar paid, which significantly helps those at low and middle incomes. But I think the important thing is median incomes at best are flat. We actually increase median income by $1,300 a year. So we actually do something to help the average person. Now, you might have something that does that too, but I don't know how you get there. And until we have that specifics, it's hard to have a comparative discussion.
Jason, can you live with 10, 25, and 35?
I haven't seen a tax plan with those rates that is consistent with the revenue that we need as a country to deal with our medium and long run deficit and the progressivity. Still haven't seen a plan that
Progressivity meaning you want
that doesn't
the higher
raise,
higher rate?
There's two things. The president on the business side is revenue neutral over the medium and long run. But if you look at his budget, if you look at the current course of the budget, our deficit and debt is unsustainable. Our approach to that is partly with revenues, which comes from high-income households, and partly with expenditure reductions, including areas like Medicare. If you are trying to do that, and you're trying to not raise taxes on the middle class, I think that is incompatible with any version of a 35% rate that I've ever seen.
Would you stay with your 39.5 or whatever it is, 39.6?
Don't take that tenth away from us.
All right.
39.6. But what we propose, and we're not proposing higher rates on high-income households. We very much have had out there for discussion and debate for 5 years now a pretty broad individual tax reform proposal in the form of cutting back tax expenditures for high-income households, bringing them more in line with what the middle class get. I think that actually reduces economic distortions while raising revenues and does it in a progressive manner. And I think that's a great basis for a debate, and I was pleased, to some degree that you took that framework up and did a variant on it in your reform.
How about,
Progressivity stays the same under the draft. We do not change that, and it does increase revenue to the government by $700 billion. And that was good enough in the fiscal cliff. I hope that's good enough in tax reform.
how about capital gains and dividends, Dave?
Well, look, again, we put a proposal out there to do that. That helps us lower rates. It actually, brings us the growth that we need. And I think what we did on cap gains helps us get to the growth numbers that Joint Tax and others have said we get. And I think that's got to be an important part of it. So, again, if you don't like what we've done, we need more.
Just last one. Governor Engler wants us to move into questions,
Yeah.
which I'd love to.
Okay.
At some point, shouldn't capital gains, dividends, personal income all be taxed the same rate?
Well, ideally, but you want to, there are a lot of trade-offs you have to make, and in order to put the plan together, we did it the way we did it. And, this is, again, specific provisions are part of a whole. And so, yes, you can talk about those, but you also need to talk about what the whole proposal looks like.
If
But I'm confident, obviously, with the combined capital gains rate, we're lower than we were in the Reagan administration. So
Right.
it was hard to do better than you did, but we did.
So when I abolish the corporate tax rate altogether, it's really what my
Yeah.
goal is. I'm out of the closet. I want to abolish the whole
Yeah.
thing. It's a waste of time, effort, money, paper, whatever. I would, however, have the dividends and cap gains and so forth pass through once, not double tax, and let the shareholders pay for it. I would. And I'll bet you that would grow a lot.
Yeah.
Not really. That's all right, we'll leave it there. I hope I've been fair, but they're not done yet. Let me take your questions. The floor is open.
We have some mics out there, Larry.
I have a mic. Any media questions?
Please identify yourself. Thanks.
Hi, Mark Heller with Bloomberg BNA. I wonder if both of you could maybe speculate a little bit. Do you expect that President Obama will be the one to have a tax reform bill in front of him to sign? Or is it going to wait till he's no longer the occupant of the White House?
He would certainly love to sign a business tax reform bill. And, I think our country would be much better off doing this sooner than later. We've already waited too long.
Well, I mean, there's no reason why we can't do that. And again, it needs to be public, it needs to be detailed, and we need to have people be very engaged so that we do it right, because it's very important. It's not just part of the economy, it's the whole economy.
Are you assuming, Mr. Bloomberg over there, are you assuming Republican Senate and House?
I think he was assuming that President Obama was going to be there.
You-
By the question, I just wonder whether, given the atmosphere of things and given the landscape, whether it's reasonable to even expect that something will get to the White House in that period of time.
Fair question. Fair question. What do you?
We have to do it. The question is, when are we going to do it? Are we going to allow more companies to find a lower tax rate, which they're going to do to maximize their returns to their shareholders? Are we going to try to get the kind of growth we want? I think we absolutely have to do it. I think people are demanding it, and so hopefully we can.
Jason, would you break off personal and corporate? Let's just say, to answer the question, I think I heard you say we'd put a corporate tax on paper. So you split the two. Not a bad deal, but I haven't heard that
We tried
before.
to design our business tax reform to be like a module that you could do on its own. And to do that, you need ways to deal with the pass-through issue, to deal with the small business issue. And we did that through things like 179, greater expensing for small businesses, as opposed to cutting the individual rate, which to us felt like a blunt tool that wasn't just about small businesses, but was about a much broader universe of high income. So we did put forward a plan that was designed to be able to be done just in the business sector while taking care of the things we care about.
I just wish, I loved the cash expensing that was in the first stimulus package. I think it was the only thing I really loved. And I remember one night having Austin Goolsbee on. It was wonderful. And he said, don't you like the cash expense? I love the cash expense.
You didn't like the NOLs?
No, it's a loophole. And that's where you get into effective tax rate problems, where you can, let's not go there. But I mean, permanent cash expensing. Now that to me is one of the golden rings of, I mean, you hear that all the time, John, from the CEO. I mean, in fact, just to go back to Fred Smith again, well, again, is one of America's most successful, that's what he wants. he actually says that's more important, now maybe it's for his business than the rate. But God, if you had made that permanent, it would have been awesome. You'd have
of
a couple
course,
more million people
the
working.
The framework the president has put forward lists as one of the structural changes something that would go in the opposite direction. Obviously, Chairman Kemp's tax reform moves in the
I
opposite
know.
direction in terms
I
of how
know.
it deals with depreciation. So
Whatever
one could
we
have an
do-
interesting academic debate around this question.
Well, whatever we do should be permanent.
Okay.
That is absolutely got to be the hallmark going forward. No more temporary tax policy. And I'm hopeful that that is something that will continue.
Other questions, please.
Mr. Furman, you talked a little bit about when.
Where are you?
Oh, sorry. My name is Lindsay McPherson. I'm a reporter at Tax Notes. You talked about on specifics as to why the administration has, in considering this, you said that you don't put out too many specifics in the wrong way at the wrong time. Can you elaborate what the wrong way and the wrong time would be, and what is the right way and the right time? And then the second part to that question is there certainly has been a lot of speculation and some good sources saying that Treasury does have legislative text that expands on the business tax reform framework. If that is, can you confirm, is that sitting in a drawer somewhere ready to go? And then that goes back to what is the right time, right way to release that?
As I said, President Obama is the first president in decades that in his State of the Union talked about lowering the corporate tax rate. He is the first president in decades to put out a framework for how you do that. That framework is, I think, a good basis for discussion. And at every point, we have tried to make that judgment strategically about what's the best way to move that forward. And by the way, we put that framework out in February 2012. That was an election year. We didn't wait like many administrations have in the past for after the election. We put out a lot of that before the election. You can certainly have a debate around it. You heard some commentary on some of our earlier international proposals, though we never actually proposed to end deferral. So I think
It's in the budget.
no, it wasn't actually.
I think it was.
Anyway, we don't need to waste time on this, but I can promise you that it was not. We proposed to take away the interest
A lot of
deduction.
Democrats have proposed ending deferral.
That may be right, but it was never in
And
our
I think the
budget.
administration was part of that too. But
Okay, but this isn't a good example, right? We have a green book. We have hundreds of pages there. And there's a lot to discuss in it. There's a lot of specifics. There's a lot of details. And to have a real conversation around those details, now we're at a minimum tax. We used to propose to limit the interest deductions associated with income that wasn't repatriated. That may have been a good idea, may have been a bad idea, but it wasn't the same as the caricature of ending deferral, which is something we've never proposed. or
Can I
supported.
get a bill with personal and corporate tax reform that's about, 10, 12 pages long? Here are the rates, here's the cash expensing, here's the territorial, and the rest of it we're throwing out. Where's deductions? You live on deductions, forget about it, all right? Or get a new lobbyist or whatever you do. That's it. No more deduction. I mean, really, great documents have been written in American history. It's 10 or 12 pages.
well, that's the kind
I
of
mean, look,
that's
all right.
the kind of framework.
Complexity
speech,
is one of the things people hate.
Yeah.
That's what I'm getting at.
and we get
All
rid
right, that was
of we get a big chunk.
attempt
We
at
get rid of
humor.
a big chunk of the code in our draft.
People they hate
But-
the complexity of the code.
But to do it in 10 pages
Yeah.
is sort of a framework or a speech or without the details because we do have a complex tax system and a complex code, and we can make it a lot simpler. And one of the things on the individual side, which we're talking about now, is 97% of people won't itemize, so they will fill out the
Right.
two-page tax. They
Right.
will not be keeping records. They will not have to, all of the sort of charitable contribution records and other things because they'll be getting the lowest rates simply by filing their return. So there are things we can do, and I would just say that I've been in favor of doing this in a comprehensive way because I think if we're going to do something to lower rates and grow the economy and help on the business side, shouldn't families also get something that helps
Yes, of
them?
course.
And the problem we have now is a lot of families feel like if only they knew somebody, or only if they sort of fit some criteria that the government had, they'd get a better deal. And that, I think, undermines the integrity of the entire voluntary tax system. And so simplification is important on the individual side because of the tax burden, the tax compliance, and the fact that you sign this stuff and send it to the IRS, and you don't know what you've really signed. And they can come after you, and there's probably nothing more frightening than getting a letter, and they seem to come on a Friday night from the IRS saying you owe more or there's a discrepancy.
Sometimes they don't know.
And a lot of times they don't.
Seriously, I've been audited. I'm sure it has no political ramifications, but my business manager handles all that stuff, and she says that they come around and they're not really sure what they're looking for. Let me ask you about family. You mentioned family. There's a debate going on inside the Republican Party about the child tax credit.
Right.
There's one proposal that wants, what is it, $1,000 a kid now? Or, I'm not sure. Yeah, is that right? So they want to raise it to $2,500 a kid. Some people think that's anti-growth. Some people think that's overkill and we can't afford it. What's your thinking on the child tax credit?
We do make that permanent in the draft, but again, that's in the context of everything else, of actually, for all Americans, many people will not be itemizing who itemize now. So, I think it is one of those important policies I think there's a lot of support for. But clearly, I think the simplified lower rates, and 97% of Americans are going to either be at 10 or 25.
Right.
And that's most of I think that's really, rather than the 6 rates we have now. And the thing is, that creates growth and higher incomes, and there's lots of benefits from that, both in terms of revenue to the government, in terms of ability for people to contribute to charity and for them to improve their lives and spend money the way they want to, because they're getting more.
Do you want to get, Governor Engler's going to give us the hook. Do you want to have the last word,
Do you
Jason?
want to do one last question?
One last-
As a wrap-up and everything else?
Okay.
There's one over there. I saw one.
I don't need to add to that.
Okay.
There's not. Well,
One last question
there,
from
one last one.
distinguished audience. Someone's pointing.
Going on there.
Am I missing? Yes, sir. I'm sorry. Yes. Just shout it out. It's cool.
I'm Mark Schaff, a reporter with Investment News. I have a question for Sean Camp. Speaking of temporary tax policies, how are the tax extenders going to be resolved this year? Is that what's your outlook for? I presume what now is the lame duck session for that issue?
Yeah, I mean, obviously, extenders have in the past been done kind of at the end, and I think that'll be no different this year. I do believe we'll have an extenders package. My view is that we should get as much permanent as we can, and that's what the House has done, and we've had big bipartisan votes on significant extenders to make them permanent. And I think that's the direction we ought to move. Obviously, that will be negotiated after the election. But
Last
it's
word,
clearly
Jason.
something we need to address.
Want to be fair.
I mean, I'll just broaden it out from, as exciting as extenders are, to say, I welcome discussions like this. I mean, we didn't get into a lot of the specifics here, and we can do that another time. But, there is a lot of low-hanging fruit in the area of business tax reform. The flip side of everything being as broken as both of you have described, and I've described, is the many opportunities to improve on that. And we're certainly going to continue to do what we can, both substantively to advance that discussion and move it forward, but also politically to try to do what we can to increase the chances that something really happens in this area, and appreciate the interest and attention that so many people in this room have had on it, with the only caveat to all of that being, this isn't the only issue, and you can't, as I said, make progress here while hurting ourselves in some other dimension. But I think there's a lot of good things we can do while not violating the Hippocratic Oath.
Chairman Camp, Jason Furman, thank you, gentlemen.
Well,
were
thank you
great.
very much.
Thank you very much.
Thank you.
And Larry Kudlow, thank you very much for a great job. We are adjourned. Thank you very much for coming.